Today, we're diving into the crucial world of risk management and financial derivatives. This topic is vital for financial stability. Our goal is to understand how to identify, assess, and effectively mitigate financial uncertainty in various contexts. Let's start by defining what financial risk truly means. It's a fundamental concept in finance. Financial risk is the potential for loss from market uncertainties, operations, or external factors, crucial for stability and minimizing losses. Now, let's explore the 4 key types of financial risks that every organization needs to understand. We'll focus on identifying the primary sources of potential financial loss that can impact businesses. First, we have market risk, which arises from fluctuations in asset prices or exchange rates. This risk involves changes in things like stock prices, bond values, or currency exchange rates, impacting investments. For instance, a sudden stock market crash can significantly reduce the value of your investments. Next, let's look at credit risk, which occurs when a borrower fails to make debt payments. This means a party you've lent money to might not be able to repay their obligations. A classic example is a company defaulting on a loan it owes to a bank, causing losses. Third, we have operational risk, stemming from internal failures, fraud, or human errors within an organization. This includes issues like system breakdowns, employee misconduct, or mistakes in daily operations. Think about cyber attacks disrupting a bank's operations. That's a clear example of operational risk. Finally, there's liquidity risk, which is the challenge of not having enough cash to meet obligations. This means a company struggles to pay its short-term debts because assets cannot be quickly converted to cash. An example is a firm that owns many properties but cannot sell them fast enough for cash. Now, let's walk through the key stages of enterprise risk management, or ERM. It's a systematic process. We'll cover everything from initially identifying potential threats to continuously monitoring them over time. The first stage is risk identification, where we pinpoint potential risks across all business areas. This involves finding all threats, whether strategic, financial, or operational, that could affect business objectives. Next is risk assessment, where we measure the likelihood and potential impact of these identified risks. We use both qualitative and quantitative methods to gauge how likely a risk is and its potential consequences. Then comes risk mitigation, where we develop and implement strategies to manage and reduce risks. This means choosing strategies like avoiding, reducing, transferring, or simply accepting the identified risks. Finally, we have risk monitoring, which involves continuously tracking risk trends and updating strategies. Here, we constantly track risks, update our plans, and report on exposure using dashboards and indicators. Let's explore some of the leading enterprise risk management frameworks that organizations commonly use. These frameworks provide structured and systematic approaches for managing enterprise-wide risks effectively. First, we have the COSO ERM framework, known for its focus on integrated risk management and governance. It emphasizes integrating risk management throughout the organization, linking it closely with governance. This framework is widely adopted, especially for establishing strong internal controls within companies. Next, there's ISO 31000, which provides global standards and principles for risk management. It offers internationally recognized guidelines and best practices for managing risks across various sectors. A key advantage is its applicability to any type of organization, regardless of its size or industry. Then we have the Basel framework, specifically designed for financial and banking risk management. This framework sets crucial regulations and standards primarily for banks to manage their financial risks. It's essential for setting capital adequacy standards, ensuring banks have enough capital to absorb losses. Finally, there's the COBIT framework, which concentrates on IT risk management and governance. COBIT focuses on managing risks related to information technology, ensuring effective IT governance. It plays a vital role in ensuring the security and integrity of an organization's information systems. Now, let's move on to understanding hedging, a powerful strategy for managing financial risk. Hedging is an investment strategy to reduce financial risk by taking an opposite position in a related asset, protecting against market fluctuations. Let's explore the core derivatives that are essential tools for effective hedging in financial markets. These derivatives serve as powerful financial instruments, specifically designed to help businesses manage and mitigate various financial risks. First, we have futures contracts, which are fundamental in managing future price volatility for commodities and financial assets. A futures contract is an agreement to buy or sell an asset at a specific price on a future date, locking in your transaction. Next, let's look at options contracts, which offer more flexibility compared to futures, providing strategic choices for investors. An option gives you the right, but not the obligation, to buy or sell an asset at a set price before its expiration. Finally, we delve into swaps, which are versatile financial agreements used to exchange different types of cash flows between parties. A swap is a contract where two parties agree to exchange cash flows or interest rate payments over a specified period. Today, we will differentiate between two critical financial exposures: foreign exchange risk and interest rate risk. These are distinct but equally crucial financial exposures that can significantly impact a company's profitability and stability. Let's start by understanding foreign exchange, or FX, risk, which is particularly relevant for global businesses. This risk arises directly from the unpredictable fluctuations in currency exchange rates between different countries, impacting international trade. It primarily affects companies that regularly conduct transactions or have assets denominated in multiple foreign currencies. FX risk can significantly impact a company's profitability, cash flows, and overall competitiveness in the global market. For example, an Indian IT company's US dollar earnings decrease if the dollar to Indian rupee rate falls. Now, let's shift our focus to interest rate risk, another significant financial exposure for businesses and investors. This is the potential for financial losses that can occur due to unexpected changes in prevailing interest rates. It directly impacts financial instruments such as loans, bonds, and various other interest-sensitive investments across the market. This risk influences bank lending decisions, corporate financing costs, and the valuation of fixed-income bonds. For instance, a company with a floating-rate loan will face higher payments when interest rates increase. Let's explore the fundamental root causes that often lead to financial crises, understanding their systemic vulnerabilities. Understanding these systemic vulnerabilities is crucial for preventing future economic downturns and maintaining financial stability. One primary cause is excessive risk-taking, where financial institutions engage in overly speculative and dangerous investments. These high-risk investments significantly increase systemic risks, making the entire financial system more fragile and prone to collapse. Another critical factor is the formation of asset bubbles, where asset prices become inflated far beyond their intrinsic value. When these overvalued assets inevitably burst, they lead to sudden and severe market crashes, triggering wider economic fallout. Weak regulatory oversight also contributes significantly, as insufficient rules allow institutions to operate without proper checks. A lack of robust regulations often enables excessive risk-taking and unethical practices, destabilizing the financial sector. Liquidity shortages represent another serious cause, where financial institutions suddenly lack enough cash to meet their obligations. Panic withdrawals can quickly cause bank collapses and widespread credit freezes, severely impacting economic activity. Finally, external economic shocks can act as catalysts, triggering crises even in seemingly stable financial environments. These sudden disruptions can profoundly affect businesses, international trade, and the stability of global financial markets. Let's now look at the exciting future trends in risk management, leveraging innovation for greater financial stability. These emerging trends promise to enhance our ability to predict, assess, and mitigate risks more effectively than ever before. Artificial intelligence and big data are revolutionizing risk management, by enabling more sophisticated analysis. AI-driven models significantly improve real-time risk detection and prediction, offering proactive insights into potential threats. Blockchain technology is also emerging as a powerful tool to enhance transparency in financial transactions. It provides secure and tamper-proof risk monitoring using distributed ledger technology, increasing trust and accountability. Environmental, social, and governance, or ESG, integration is becoming increasingly vital in comprehensive risk assessments. This involves assessing risks related to climate change, social impact, and robust corporate governance practices for long-term sustainability. With increasing digitization, there's a growing focus on robust cybersecurity measures to protect financial data. We see a growing emphasis on AI-based cybersecurity solutions, crucial for effective digital risk management in today's world. Let's quickly summarize the key concepts we've covered in our discussion on risk management and financial derivatives. These are the essential takeaways you should remember to apply these principles effectively in real-world scenarios. Remember, financial risks encompass various types, including market, credit, operational, and liquidity risks. Enterprise risk management, or ERM, offers a structured approach to identify, assess, mitigate, and monitor these risks comprehensively. Hedging strategies use derivatives like futures, options, and swaps to reduce potential financial losses from market fluctuations. Foreign exchange and interest rate risks are crucial for global businesses and require specific, tailored management strategies. Financial crises often stem from excessive risk-taking, asset bubbles, and weak regulations, demanding robust mitigation strategies. Future trends in risk management involve integrating AI, blockchain, and ESG principles for enhanced stability and resilience.